If you own an IRA, then you know these accounts provide tax advantages for individuals who set aside money for retirement. These accounts are a great way to save for retirement, but some special rules apply. This video focuses on required minimum distribution rules for certain IRA owners. A required minimum distribution, or an RMD, is a required annual withdrawal amount for traditional, simple, and SEP IRA owners who are 70 and a half or older. The first RMD must be taken by April 1st in the year following the year you turn 70 and a half. All subsequent RMDs must be taken by December 31st of each year. Because distributions from these IRAs are usually taxable, we recommend you taking your first distribution by the end of December rather than waiting until April. This will prevent two taxable distributions in the same calendar year. The RMD is based on your account balance and your age. Divide your account balance as of December 31st of the prior year by your life expectancy factor. These factors can be found in IRS Publication 590. Most individuals will use the Uniform Lifetime Table. However, if your spouse is more than 10 years younger and sole primary beneficiary of your IRA, you may use the Joint Life and Last Survivor Expectancy Table to calculate your RMD. Generally, the higher the balance or the older your age, the higher your RMD will be. If you do not distribute the full RMD by the deadline, you may be assessed a 50% federal tax penalty on the difference between the amount you withdrew and the amount you should have withdrawn. Most IRA custodians allow you to set up recurring automatic distributions from your IRA so that you don't miss this important deadline. It's important to remember you're allowed to aggregate the RMD amounts for multiple IRAs, even if they're held at different financial institutions. You don't have to take a withdrawal from each account. Just make sure your total withdrawal equals or exceeds your total RMD. Another way to satisfy your RMD is by taking a qualified charitable distribution, or QCD. Traditional IRA owners have the option of donating an otherwise taxable IRA distribution to a qualified charity. If you are someone who doesn't use your RMD to cover living expenses, the QCD option allows you to satisfy your RMD for the year, and the distribution can be excluded from income on your federal tax return. There are limits to the amount you can donate tax-free each year. Individual filers can donate up to $100,000. Married couples filing a joint return can give up to $200,000 or $100,000 each. Keep in mind, the RMD rules discussed in this video are applicable during an IRA owner's life. Once the funds are inherited by account beneficiaries, the RMD rules are different. To discuss your specific situation, please contact your IRA custodian or your financial advisor for assistance.